Hey investors, welcome back to the channel. Today, we're diving into one of the most requested comparisons, Ascendas REIT versus Mapletree Industrial Trust. To Singapore REIT heavyweights battling it out for your investment dollars. I've done deep research on their latest 2025 performance data, and by the end of this video, you'll know exactly which one might be better suited for your portfolio. Let's jump in. Portfolio breakdown. First, let's break down what these REITs actually own, because their portfolios are more different than you might think. Capital in Ascendas REIT, or CLAR, is Singapore's first and largest listed business space and industrial REIT with a massive $16.8 billion portfolio value as of October 2024. 229 properties spread across Singapore, Australia, Europe, and the United States. A diversified focus on business space, life sciences, logistics, industrial, and data centers. Mapletree Industrial Trust, or MIT, takes a different approach. $9.2 billion in assets under management as of December 2020 for 141 properties primarily in Singapore and North America. And here's the key difference. A major focus on data centers, which now make up 55.9% of their asset value. This portfolio difference is crucial to understand. CLAR offers you broad diversification across countries and property types, while MIT is making a much bigger bet on the data center boom. That's like choosing between a well-balanced index fund versus more focused tech sector ETF. Section 2. Financial performance. Let's dive into the numbers that matter most to us as income investors. Distribution per unit DPU, the actual cash hitting your account. CLAR delivered 7.68 Singapore cents for the second half of FY 2024, growing 3.2% year-on-year. MIT's most recent DPU was 3.41 cents for Q3 FY 2024, up 1.5% year-on-year. Looking at broader performance metrics, CLAR's net property income rose 1.4% to $521.5 million. MIT's gross revenue grew 2% to $177.3 million, and NP increased 2.6% to $133.2 million. What about occupancy? The lifeblood of any REIT, CLAR improved to 92.8% portfolio occupancy. MIT maintained a solid 92.1% occupancy. Both are showing strong fundamentals, but CLAR is currently delivering slightly higher DPU growth. Section 3. The rental reversion story. Now, let's talk about one of the most critical metrics for REITs: rental reversions. This is the percentage increase in rent when leases or renew, and it's a key driver of future growth. CLAR has been absolutely crushing it with average rental reversions of 11.6% for FY 2022 for an impressive 14.4% in Q3 2024, accelerating from 11.7% in Q2. And check this out, their Singapore logistics segment delivered a mind-blowing 31.4% rental reversion. US properties also perform exceptionally well with 22.9% reversions, driven by business space and life sciences. MIT is showing strong performance too. Positive rental reversion of 11.2% for the first half of their financial year. Consistent positive reversions across all property segments. These rental reversion numbers are not just abstract metrics, they directly impact future DPU growth. When a REIT can consistently renew leases at significantly higher rates, that additional cash flow eventually makes its way to shareholders. Let me explain what's driving these impressive rental reversions. Post-pandemic demand recovery. Low expiring rents from COVID-era leases. Supply constraints in key markets. Strong demand for specialized spaces like data centers and logistics. Strategic property enhancements by both REITs.
Section 5. Analyst perspectives. What are the experts saying about these REITs? For CLAR, analysts have given it an ad rating with a target price of $3.10, representing a 19.5% upside. They praise its diversified and resilient portfolio, positive outlook based on strong rental reversions, and strategic redevelopments. For MIT, maintaining a buy rating from Maybank Research, recognition of its stable performance and successful data center strategy. Positive response to its recent acquisition in Tokyo. The consensus is clear. Both REITs are viewed favorably by analysts, but your choice should depend on your specific investment goals. Section 6. Investor Decision Framework. So which REIT should you invest in? Let me break down a framework to help you decide. Choose CLAR if you prefer geographical diversification to reduce country-specific risks. You want exposure across multiple property types, not just one sector. You value the higher recent DPU growth 3.2% versus 1.5%. You're impressed by the stronger rental reversions 11.6% versus 9.8%. You prefer a larger scale REIT $16.8 billion versus $9.2 billion portfolio. Choose mid if you're bullish specifically on data centers and digital infrastructure. You want concentrated exposure to this high-growth sector 55.9% of portfolio. You're comfortable with higher sector concentration risk for potentially higher growth. You value MIT's focused strategy in fewer markets. You believe in the long-term growth story of cloud computing and AI infrastructure. The beauty is there's no wrong answer. Both are well-managed REITs with strong fundamentals. Your choice should align with your investment thesis and risk tolerance. Conclusion. As we wrap up, I'll share my personal take. These two REITs actually complement each other beautifully in a diversified portfolio. CLAR gives you broad exposure across multiple sectors and geographies, while MIT provides targeted exposure to the data center boom. In fact, owning both might be the optimal strategy for many investors, giving you the stability of CLAR's diversification with the growth potential of MIT's data center focus. If you found this analysis helpful, smash that like button and subscribe for more Singapore investment content. And I want to hear from you. Which REIT are you leaning toward and why? Drop a comment below. Until next time, happy investing. Disclaimer: this is not financial advice.